Hello, everyone. Welcome back to another episode of Signal or Noise. It's episode 62. Charlie Bilello here, and with me, as always, Peter Mallouk. Just one topic for today. It's a question you've probably been asking. We're getting a lot of questions like this from clients. Are we in an AI bubble? And before we attempt to answer this question, first we have to define what exactly is a bubble. And there's no one definition of a bubble. You see many different definitions out there. I picked out a few here. One from Robert Shiller, Nobel Prize winner. Professor Shiller defined a bubble as the following. It's a social contagion, an epidemic whose mode of transmission is word of mouth. It's emotional. People keep hearing about price increases. There's a tinge of envy about other people who have done well, which brings more and more people into the market. This in turn pushes up prices. And Schiller, what he's essentially saying, it has to be emotional. It's psychology based. And he wrote a book called Irrational Exuberance talking about just this. And he actually released it right before the dot-com bubble peak in 2000. And then he follows up with a second edition of that book, perfect timing, essentially, right before the housing market bubble peak in 2006. So essentially, the two biggest bubbles we've seen in the past 50 years, Robert Shiller having perfect timing and really talking about psychology as the underpinning. Now, Cliff Asness of AQR, he takes a more quantitative kind of approach to it, saying the term bubble should indicate a price that no reasonable future outcome can justify. I believe that tech stocks in early 2000 fit this description. I don't think there were assumptions short of them owning the GDP of the earth that justified their valuation. So essentially saying that even if you had the most charitable view of the future, saying everything is going to work out perfectly, even then you can't justify today's lofty valuation. And that's his definition of a bubble. And finally, we have Eugene Fama, who won the Nobel Prize in economics the same year as Robert Shiller, but a very different view. He was more of an efficient markets guy, saying stock prices are not predictable, and therefore saying bubbles are impossible to predict here. He's saying, I don't even know what a bubble means. It's easy to say prices went down. It must have been a bubble after the fact. I think most bubbles are 2020 hindsight. Now, after the fact, you always find people who said before the fact that prices are too high, but people are always saying prices are too high. They, meaning bubbles, have to be predictable phenomena. And so various ways of defining it. I really think it should be a blend of all three, in the sense that I don't agree with Fama, who's essentially saying you can't define it, you don't know what it means, and perhaps it doesn't exist, because we've seen it. We've seen it with the dot-com bubble, we've seen it with the housing bubble. And in terms of what Aziz is saying, that makes perfect sense, because there has to be a price that's so extreme that you can't justify that asset growing into it, and therefore that would meet the definition of a bubble. But I also side with Fama in saying it's impossible without 2020 hindsight to say when that bubble, even if you believe it is a bubble, when it's actually going to burst. So Peter, what do you think of this? Is there a definition here that resonates with you most?
Well, I think of all of these, Fama's resonates the most, because he's basically saying, like, look, everyone loves to predict after the fact. Oh, the prices were high, but it's really hard to know if you're in a bubble or if you're in the middle of an economic revolution or a tech revolution or an AI revolution, where there really will be future earnings from companies that don't have earnings today. I think where bubbles are predictable is when you start talking about people buying images of rocks and monkeys, digital images of those, or they're buying tulips, or they're buying one of the 9,999 cryptocurrencies that are out there that might not be two or the three that are most credible. Yeah, there's speculative bubbles, and it's easy to say down the road, hey, there's going to be a lot of suffering with meme stocks, or with a lot of crypto, or with a lot of these other ridiculous quote unquote assets. But Fam is talking about the stock market, and the stock market, it's very hard to predict the winners and the losers. And in retrospect, you go, oh, well, Google wasn't in a bubble. Apple wasn't a bubble. If you look back from the tech internet bubble to today. But there were some stocks that went to zero, like pets.com and so on. So it's easy to go, oh, there was a mania. But the reality is there were a tremendous amount of winners in there too, that people thought were a bubble as well.
Yeah, so it's really in the eyes of the beholder. You can have different people disagreeing about it because no two bubbles look alike. And what you're saying makes sense. I think if we look at historical bubbles, Peter, there's a big difference between the tulip mania and the Japanese asset bubble and the dot-com bubble, right? One, you're just talking about pure speculation. There's no basis for fundamental value. And the other, you have an asset class in the case of Japanese stocks. They just got wildly, wildly valued on a basis of earnings. Same thing with the dot-com bubble and the housing bubble as well. You can value it based on, you know, a perceived income in terms of what you could rent that out, and that multiple in terms of where it was in 2006, similar situation. So I think all of the definitions have made sense in the past. Really, the hard part, as you said, is anticipating it before the peak, and that's been shown to be impossible to time. What we do know, though, Peter, is that following all of these examples, when you are in a bubble, we know that when it does pop, there's going to be pain on the other side. And this is why we're getting so many questions today. If you look at the declines, you're talking about 70, 80, 90% in terms of what happened following these famous bubbles. And the housing bubble in 2006 took the housing market down in the US on average 30%, but there were many areas that were down more than that. Okay, so let's talk about today. What are some of the warning signs of a bubble? The number one thing that you've been hearing about, Peter, and we've talked about it a number of times, but this chart keeps moving up. Valuations are pretty high today. 98th plus percentile, if looking at the CAPE ratio. We're now at 40, above 40. The only other time period in history that we saw valuations as high would be 99 and 2000. What do you make of the valuations? Is this alone an argument to say that perhaps we are in a bubble because valuations are approaching the peak in terms of valuations back in the dot-com era? And if it looks the same, then you can make the same argument.
I think it's definitely cause for concern and something that people would want to pay attention to as investors. But I think what's a little bit different in terms of the way we look at this calculation today is we're seeing a real revolution. Okay, we're in the middle of the artificial intelligence revolution. Is not theoretical. It's happening. 1,000 years from now, and we're looking at history books. They're going to point to this period of time, just like they'll point to the internet revolution. And the market is basically looking at the companies that are driving this and saying, hey, these companies are going to rule the world and will probably be the winners of the AI revolution. And they're priced accordingly. Now, the market's going to be wrong about some of these, and those stocks will completely blow up. It's going to be right about some of these, and those stocks will continue to do well. But we're not seeing it across the whole market. We can't really apply this and say, oh, the thousands of stocks, they're all in the 98th percentile. That's not really what's happening here. We're seeing a lot of companies very weak valuations, but we're seeing some companies which have a very large market capitalization, greater than the GDPs of most countries, at peak future expected earnings, which is driving a lot of these valuations.
And that's similar, right, to back in 2000. We saw it wasn't the entire market, and it certainly wasn't, if you look at small caps or international emerging market stocks, they didn't all have that same extreme valuation. So some would argue there's a parallel there to today where we're seeing it concentrated in the companies that are viewed to be the leaders of this AI revolution.
What's crazy though this time is the leaders of the AI revolution were already $1 trillion valuation companies, right? So back then we didn't have companies anywhere remotely near that valuation. I mean, even 10 years ago we didn't have $1 trillion company. I think the first one was either Exxon or and maybe Apple shortly thereafter took over. Well, now all of these AI revolution companies, they were already $1 trillion companies before this started. Microsoft, Apple, now Nvidia, Meta, and so on. So I think we're seeing mega companies with mega expected earnings and expected to be the winners of the AI revolution. So we're just creating a valuation, a concentration of valuation unlike anything we've ever seen.
So let's talk about that concentration now in the tech leaders. And again, this is something we've been talking about for a few years now on the show because it just keeps on becoming more and more concentrated. You're talking about 10 years ago, the Magnificent Sevens combined weighting in the S&P 500 was about 10%. And now, Peter, you're at a record 36%. Going back to 1980, we haven't seen 7 companies with this high of a representation ever. It's much higher than where we were at the dot-com bubble peak in 2000. Does this alone cause you some concern in terms of now NVIDIA's 8.5% of the S&P 500?
I think that I would say yes, some concern. I think that it's incredible the percentage. You take one company like Nvidia is more than the bottom several hundred companies of the S&P 500 combined. So I think that what we're seeing is when you own the market, you get the benefit of whatever the winners are. I mean, it's like Bogle said, you don't look for the needle in the haystack, just buy the haystack. I mean, if you bought the S&P 500, you got all these, grand slam situations like Nvidia or Microsoft coming back, Apple, all of these companies. And so the benefit to the diversified investor is they bought the market and they got the benefit of the outsized growth of these winners. Now, there's always outsized growth of winners, but the concentration now is very significant. And why that might concern an investor as well. The good news is you get the benefit of the concentration, and we've seen that this year. A lot of the market's weak, but these are doing great. You've got great returns if you own the market. Is like, look, if one of these companies has a big problem, then individual investors going to feel it. So, for example, with Nvidia, you could argue Nvidia is not Apple. Apple, you use the phone, you're in that ecosystem, you have a lot of friction to leave your iPhone and go do something else. You might not think anything else is good, and you might have to, port over your phone number, and then all these apps you're used to using and services you're used to using, you're no longer in it. You're in iTunes and so on. I mean, Apple has a moat, right? If you're using, it's very hard to break that moat. NVIDIA, some would argue, has a head start. Okay, other people can make chips. Other companies can make chips. In fact, they are starting to make chips. But the need for chips is expanding so much that even though NVIDIA's share of the chip market is declining slowly, the pie is expanding so much, its earnings are going up. Well, one day that math will change. That's a certainty, right? And if you've got a lot of eggs in that basket, you're going to suffer disproportionately relative to the market. I think that's the reason for concern. But we go back to Fama's quote. We don't know how long this is going to take. We don't know what else is going to evolve. We don't know what the next NVIDIA is. We don't know the next Microsoft that's going to make a comeback. So I'm still on the side of the diversified investor, coming out ahead of somebody trying to time all of this every day of the week.
Yeah, and just incredible, Peter. We got to talk about last week, NVIDIA becoming the first $5 trillion company. And it was only back in, I think, 2018, Apple became the first $1 trillion company. And then 2 years later, it hit 2 trillion, and less than 2 years after that, it hit 3 trillion. And now NVIDIA, just in July, becomes the first $4 trillion company. Now already, just a few months after that, hitting $5 trillion, which you and I have talked about. This is bigger than all of the stocks in Italy and Germany. Put them all together, this is now $1 trillion more than all of those stocks combined.
Yeah, it's incredible. I think you can even throw China in there and still make it work. It's incredible what is happening at NVIDIA, and the questions like how long before someone else comes along or finds a way, as it seemed like there was a threat of a year ago, to do this with less of a need for their product. And so it's going to be fascinating to see how this story plays out.
Yeah, 100%. It really comes down to high expectations of future earnings growth. So if it were the case that if you added up all of their net income of the Mag 7 and you took that as a percentage of the S&P 500 and it was the same as their market cap weighting, then it would be hard to argue that we're in anything close to a bubble. But you could see the difference here, 26.8% in terms of their share of net income and close to 36% in terms of their market cap weight. And the bullish interpretation is, well, yeah, of course, the weight is higher. They're pricing in future earnings growth of these 7 companies being much bigger than the rest of the S&P 500. So it's justified. And the bearish interpretation would be, well, no, investors are expectations are too high, and this is just a reflection of that. They're pulling forward those future returns by assuming that earnings growth is going to happen.
I think it's definitely one thing I think everyone can agree on is it's priced to perfection. If there are signs that the future earnings will not be as those invested in the Mag 7 anticipate, you'll see a sharp correction very quickly.
Yeah, and looking at Nvidia, right? 4% is its share of net income. 8.6% is the index weight, and Nvidia is yet to disappoint, and it hasn't reported its third quarter earnings yet. But when that happens, that will be a test for not just
Yeah.
Nvidia, but of course the market as a whole. We have to talk about, because I'm hearing a lot of people dismiss saying, "Well, there's not these examples of these crazy valuations like we saw in the dot-com bubble era." But Peter, I have to argue Palantir would be one such example here. I just noted on X the other day, it traded as high as 240 times forward earnings. Forward earnings. And I went back, tried to find a company in history that's been this big. You're talking about $490 billion market cap that has traded at this high of a valuation. And there's no comparison in terms of NVIDIA. NVIDIA was trading at 40, 50 times forward earnings. This is 240 times. So there is some speculation going on. And in terms of forward price to sales ratio, 87 times forward sales. So when I hear people say, well, there's not these examples of these crazy valuations, there are a few of them today. And I think Palantir would be one example here.
Yeah, it's a big bet on the surveillance state prevailing, but there is the single stock that to me is the least explainable. The valuation is least explainable. If I was a betting man, and I'm not, but if I was, and I had to pick one stock, somebody said you have to short one stock, this would be the one. Partially because it's insanely overvalued, and also partially because I think this is one of the most evil companies on planet Earth. But it will be interesting to see how this plays out. I just cannot make sense of this stock and what's happening with it. And it'll be interesting to see when we get into a real correction or bear market how this plays out.
For sure. And now, how about the capital investment here? And I guess there's two ways to look at it. Some people are arguing that this is a good thing because there's so much cash flow in the big tech companies, Microsoft, Amazon, Google, and Meta, that they're able to do these huge investments, capex into mostly AI and data centers. But Peter, it's kind of alarming the rate of growth that we're seeing over the past few years. In a very short period of time now, these four companies alone are projected to spend about $400 billion this year on an annual basis. And just a few years ago, that was $100 billion. So we've done 4x increase in these big four companies in terms of capex, an enormous, enormous expansion. And so the question there, bringing it back to the bubble, is this overinvestment in terms of, are these companies getting too excited and they don't want to miss out and they don't want to be the one who doesn't spend enough, and therefore there will be overinvestment where we'll only know a few years from now that not all of this money is going to productive sources, and they may not end up needing all of this computing power that they're spending money on today.
I think they're doing exactly the right thing. I think one of the things we've learned over the last few decades is the US has become a winner take all market. This is new, where you just have a couple big winners, especially in the tech space. And if you're not in the couple big winners, your days are numbered. They view all of this as an existential threat and the single biggest opportunity. It's the ultimate defense. It's the ultimate offense. It's a bet on existing and thriving in the future, and all of them want to be in that winner's circle. So in all cases, I think the spending is completely justified.
And just look at the increase over the last few years. This is why people are worried here, Peter. We're talking about Google, 229% increase in capex in 3 years. Microsoft, 208%. Amazon, 114%, and Meta more than doubling their capex. There has to be an upper limit, though, doesn't there? And are they? The question: these are smart people. These are the biggest, most profitable companies, but are they believing the hype too much? Are they you just get caught up in it. And how could they? The question, Peter, with the technology becoming obsolete so quickly, this is the question I have: is how can they be sure that they're the billions, tens of billions of dollars that they're spending now every single quarter? How can they be sure that they won't have to re-up that spending a few months from now? Maybe they are sure of that, and they're still viewing it as too big of a risk.
Yeah, I mean, they can't be sure, but the consequences of being wrong are extremely negative, right? If they get left behind of the AI revolution, their company is not going to be in the Mag 7 for long. And so I think it's a moment in time where everyone's going all in, and rightfully so. And how many false starts there will be is almost irrelevant in the ultimate math of how this is going to work out.
So you're viewing this winner take all, and they seem
Yeah.
to be viewing that as well. Speculation, always part of a bubble, Peter. There are now companies, zero revenue companies like Oklo. It's a nuclear energy company, so we know AI hugely energy intensive, and this company with no proof of a dollar of revenue yet recently hit a market cap of $25 billion. There's other examples you can point to. Again, these are kind of the hallmarks of bubble. This is what people point to back in the dot-com era, where many companies had little to no revenue, and yet investors were assigning high valuations. And then in terms of risk appetite here, Peter, I know this is something you touched on recently on X. We're just seeing more and more investor behavior saying, I want more risk, which is what you tend to see during a bubble, because they're seeing these huge appreciation, and securities are saying that's not enough. Let's put more leverage on it. So volatility shares recently filed for 5x levered ETFs, and not on boring consumer staples companies, not Coca-Cola and Pepsi. These are the most highest volatility companies out there. You got crypto in there as well. You got sectors like gold miners and gold and silver, semiconductors, 5x leverage. Give me your take on this. Is this a signal of perhaps the sentiment picture that Robert Schiller was kind of talking about?
Yes, this is a mania signal, and we see this when super speculative money comes into the marketplace, when speculative products are designed. It is not a good sign. And the people that come in late and start to do these things are usually the people that get burned the most. These kind of investments are weapons of mass financial destruction. It's going to end very, very, very badly for
You're
the
just talking
people.
about Yeah, you're
Yeah,
just talking about 20% move, Peter, in a given trading
yeah,
day, which many of
you're
these
wiped
companies
out.
have had,
Yeah.
and you're wiped out. And
Mhm.
it's not a theoretical example. There was a
Yeah,
3x short AMD ETF that went
right.
bust recently after it gapped higher 38%, and that was a
Mhm.
complete loss. So hopefully these aren't approved, but it seems like people are expecting them to be. And you've talked about the increase in leverage in crypto as well. We're seeing these perpetual futures with up to 100x leverage. You're just talking about a 1% move to completely wipe you out. So if you're watching this, needless to say, stay away from things like this. This only occurs, I would say, Peter, during a bull market run where people don't think there's any risk at all. And so they're reaching, trying to take as much risk as possible. And it almost
Right.
always does not end well. All right, let's talk about the rebuttal here. Not everyone believes we're in a bubble. And here are the four arguments. Tell me which one resonates with you, or maybe they all do. Number one, this is a technological revolution. And so it's not the same, obviously, as a tulip mania. There's a real fundamental underpinning. There's a story similar to the internet revolution. And we're already seeing productivity gains, Peter, and that's likely to continue. We're seeing corporate adoption already in big tech. If you listen to their earnings calls, they're already using this technology to boost revenues, to boost profits in their cloud businesses, advertising, and the expectation is, okay, then smaller companies are now going to follow. And then there's the case, okay, yes, valuations are high, but perhaps future earnings will support those lofty valuations today. And Nvidia being kind of the template, it was very expensive a few years ago, and it was one of the few companies in history to grow into an enormously high valuation. And some people are making the case perhaps the S&P 500 overall will do the same. And lastly, people are saying this is institutional capital. It's not retail money. These are major corporations making these investments, PE, venture capital, long time horizons. And so therefore you're not going to see a quick pullback. Do any and all of these make sense to you in terms of the counter to potentially being in a bubble today?
I think we're in a genuine technological revolution, that AI is real. They're going to be mega, mega, mega winners. Some of them are evident, and there will be some big losers. And I do think we see the real corporate adoption, and that some of the companies will grow into the valuations that we see today, and some will exceed them, and some are going to completely collapse. On the institutional money, PE, VCs, I don't consider that money much smarter than everybody else, so that one doesn't resonate with me quite as much. But there will be winners and losers, and we're going to see some of them grow into their earnings, much like Apple and Google did in the early 2000s, and we're going to see a lot of them implode.
Yep, that makes sense. And so, really, if you think we're in a bubble, you're not in a bubble. What should an investor do? That's the end question here. You have a portfolio, you're worried about this bubble. And my advice to people, Peter, if they're thinking about this today, is let's just assume it is a bubble. Right? There's enough signs to say that there's froth in the market and we have different things. Assume that it is. And even if it's not, you could still have a nasty bear market. Right? You could still have a big decline even without a bubble. So you should always be prepared for that. And number one, Peter, would be what you always say: have enough in bonds and cash to meet your long, short term liquidity needs. So you don't have to sell if there is a long bear market like we saw after the 2000 peak.
That's right. Quit focusing on the market, focus on yourself. Even if everything was perfect, there was no bubble. If there's a terrorist event tomorrow, the market's going to go down a lot, right? So you always have to have enough to protect yourself against a bear market, have enough in cash to cover the next few months, have enough in bonds to cover the next 5 years. You're going to get through whatever correction or bear market or pullback or bubble bursting or whatever at any moment in time, and you're still going to be in stocks for the long run, which is the asset class that's going to carry you forward. It's going to stay ahead of inflation, not perfectly every day, but over time it will, and it's going to be what allows you to retain your purchasing power, and it gets you through every bear market, whether it's 9/11, the tech bubble, 08, 09, or COVID. You put the time horizon out, you're going to win there. Try not to time the market and the bubbles day to day, month to month, or year to year, and bring the decision making back to your own needs.
Yeah. And what I have here in terms of risk tolerance, Peter, now is a perfect time to think about your risk tolerance. We talked about in the last episode, Munger saying if you can't handle a 50% decline in the stock market, then you shouldn't be invested in stocks. Well, just do the math. What is your exposure to stocks? Cut that in half and turn it into dollars and say, well, how would you feel if you had that short term loss? We know it will come back eventually. How would you feel? And if you feel like, that you can't handle that, well, then perhaps you need to have more in the lower risk asset classes than you do in stocks. The bubble, bull market is the time when you want to make that decision, not after the fact. Like back in April when stocks were going down, that is not the time to reevaluate your risk tolerance. Now is a perfect time. And finally, Peter, this is the most important point: is all asset classes are not the same today. So everything in your portfolio isn't going to decline equally, assuming this is a bubble and assuming there's a big bear market and a big decline, which is to say that not everything is valued the same today. So make sure you're really diversified. If we look at that 2000 to 2009 period, I think this would probably surprise a lot of people because it's known as the lost decade, right, for the US stock market. But if you had allocations to real estate, REITs, emerging markets, small caps, bonds, your diversified portfolio actually would have done okay. But if you were concentrated in that asset class, which was really large cap growth stocks, that was the highest valuation at the time, you would have lost a third of your portfolio.
Yeah, be diversified, spread the eggs across a variety of baskets. The more high net worth a family is, the more likely they are to do that. Do it as early as you can.
Yeah, and just a final point there on valuations, because we showed that CAPE ratio earlier of the U.S. stock market being highest valued since 2000. And there's a big difference between U.S. international, U.S. large caps, and U.S. small caps. So what I'm showing you here is the CAPE ratio for the U.S. stock market, highest since 2000. If you look at European stocks, and they've had a good run this year, Peter, but still not trading at anything near an extreme 21 times. So if there is a bubble today and we see a similar burst like we saw after 2000, you'll be happy you had a diversified portfolio. That's the biggest takeaway. Don't have all your eggs in that one basket, even though that one basket has been doing, of course, better than anything else. Okay, Peter, great place to end the show today. Thank you, everyone, for joining us on Signal or Noise. If you're watching this on YouTube, hit that subscribe button, leave us a comment. We're also available on Apple and Spotify. And Peter and I will see you next time on Signal or Noise.